What if I told you that the number everyone's talking about right now, the new state pension rate for 2026, isn't actually the number most people will receive? Not because of a mistake, not because of a scandal, but because of one detail that gets left out of almost every headline you'll see this year. This isn't a warning designed to alarm you. It's a clear, honest breakdown of exactly what's changing with the state pension this year, what the full rate actually is, and why the amount that lands in your account might look completely different from the number splashed across the news. Right now, something has just been confirmed about the state pension for 2026, and the details matter more than most people realize. Before you assume you know exactly what you're getting this year, stay with me, because the real picture is more layered than a single headline figure. Let's start with what's actually happening, because this is where most explanations stop too early. From April 2026, the full new state pension rose to £241.30 a week. Over a full year, that works out to roughly £12,547.60. This is the figure you've probably seen quoted everywhere, and it's real. But here's where things start to get serious. That number is the maximum. It is not automatically what you receive. It's the ceiling, not the floor, and the gap between the two can be significant depending on your personal record. Stay with me, because this next part explains why. This increase came from something called the triple lock, a guarantee that the state pension rises every April by whichever is highest out of three measures: the rate of inflation, the growth in average wages, or 2.5%. For 2026, that comparison produced a rise of 4.8%, one of the largest increases since the triple lock began, adding up to around £575 a year for someone already receiving the full amount. But notice that phrase, already receiving the full amount, because that's exactly where the confusion begins for so many people. Here's what most people are not being told. Whether you get the full £241.30 a week depends entirely on your national insurance record, specifically, how many qualifying years of contributions or credits you've built up over your working life. To receive the complete new state pension, you generally need at least 35 qualifying years. If you have fewer, your payment is reduced proportionally, and you need at least 10 qualifying years just to receive anything at all. This means two people who both retire this year at the same age could receive noticeably different weekly amounts, simply based on years worked, career breaks, time spent caring for family, or periods of self-employment with lower earnings. But wait, it gets even more layered, because there's a second version of the state pension still in payment right now, the basic state pension, for anyone who reached state pension age before the 6th of April 2016. If that applies to you, your full rate for 2026 isn't £241.30. It's £184.90 a week instead. Now, this doesn't mean older pensioners are simply receiving less for no reason. Many people on the basic state pension also receive an additional amount on top, sometimes called a protected payment or additional state pension, built up through the old system, and that additional portion rises separately, in line with inflation rather than the triple lock. So if you're on the basic pension, your total figure is genuinely a combination of two different numbers, not just the headline rate you'll see quoted in the news. And just when people think they understand this, they miss one key detail. Your state pension age itself is shifting too. It's currently being gradually increased from 66 to 67, with that change taking place between April 2026 and April 2028, meaning some people expecting to claim at 66 this year may find their actual qualifying date has moved slightly later than they assumed. A further rise to 68 is already legislated for the mid-2040s. If you haven't checked your personal state pension age recently against your date of birth, this is worth confirming directly, because assuming an old age boundary still applies could throw off your entire retirement timeline. Now let's slow down, because here's a detail that surprises even people who follow this topic closely: deferring your claim. You are not required to start taking your state pension the moment you become eligible. If you choose to delay claiming it, the amount you eventually receive increases by roughly 1% for every 9 weeks you defer, which works out to close to 5.8% for every full year you wait. For some pensioners who have other income in the earlier years of retirement, this becomes a genuine strategic choice, trading a smaller pension now for a larger one later. It's not the right decision for everyone, but it's an option very few people are told about clearly at the point they first become eligible. So now you understand the real shape of this update. But here's the question that actually matters. Why does the headline number get repeated so often without this context attached? The honest answer isn't a conspiracy. It's simply how large national figures get reported as one clean number, because a single statistic is easier to publish than an explanation of 35 qualifying years, protected payments, and deferral maths. That simplicity isn't wrong, but it isn't the complete picture either, and the gap between the headline and your personal reality is exactly where confusion tends to creep in. So, how do you find out what you'll actually receive? Let's keep this simple, because it doesn't need to be complicated. The most reliable step is to check your own state pension forecast directly through the official government online service using your Government Gateway login. This shows your personal projected amount based on your actual national insurance record, not the generic headline figure. While you're there, check your state pension age as well to confirm exactly when you become eligible under the current rules. If your forecast shows a reduced amount due to missing qualifying years, it's worth checking whether voluntary contributions could close that gap before certain deadlines pass. And if you're weighing up when to claim, take a few minutes to think through whether deferring makes sense for your specific financial situation, rather than assuming you must claim the moment you're eligible. None of this requires a solicitor or a paid advisor to check. Your personal forecast, your state pension age, and your national insurance record are all available directly and for free through the official government service. And here's something worth holding on to as we close this out. This isn't about blame, and it isn't fear for the sake of fear. It's about clarity, because clarity is what turns a confusing headline into something you can actually plan around. The same pension update that felt like just another number in the news a few minutes ago is now something you can check against your own record, your own age, and your own decisions. That shift, from a generic figure to a personal picture, is where real retirement confidence begins. If you've made it this far, you now understand something that most headlines never explain, that the number everyone's quoting is a ceiling, not a guarantee, and the only way to know your real figure is to check it yourself. Stay aware, stay informed, and don't let a single headline number stand in for your actual retirement picture.